Morgan Stanley Wealth Management is getting ready for a recession. The company announced it would no longer advise clients to have a position in junk bonds, saying that, quote, late cycle dynamics are clear. Let's bring in Dani, Bloomberg Markets reporter. Hi.
Hello.
So what's behind this call?
So Morgan Stanley is basically pointing out a couple things. One is how late we are in this cycle right now. So they're saying, look, we're hitting a peak right now. And once you head towards that recession, to be clear, they're not saying we're going to have a recession this year in 2018, but all signs indicate that we're headed that way. And they like to say, credit investors always the ones to pick up on those signals more soon than stock investors do. So in order to gear up for that impending change as we have liquidity spigots tightening, as they see less surprises coming in economic data and earnings data, they've recommended to completely remove all junk bond holdings.
And in the interim, we could even see a boost from tax cuts, which could provide fresh momentum in the economy. But they're almost looking beyond that, aren't they?
Well, actually, it's interesting because it's almost a negative to them, because they say, look, you might have this boost from tax cuts, but it's kind of artificial. You're going to have this excessive attitude in the market that is sort of indicative of a coming recession. So when you look at earnings, sure, operating margins might hit a peak, but it's going to be because of those tax cuts. It's not for a really healthy reason of better growth, of better sales.
Dani, it's interesting because if you look at our Bloomberg chart library, the chart 3701, it is the Bloomberg Barclays Global High Yield Total Return Index, and you can see, we're at highs, we're at records, but it's a bit of a slash and burn to completely, go from whatever your allocation is to zero, isn't it?
Right. I mean, that's sort of the remarkable thing here, to be talking about completely getting rid of your allocation when when they appear so healthy right now. But look, this isn't the first time Morgan Stanley has recommended doing this. Back in the summer, when credit markets looked like they were peaking, they also recommended a reduction. But look, a lot of this is sustained for a fear of missing out. It is really, really hard to make that big move when every day you wait, every day you come in, markets are trading even higher. But that said, people like Morgan Stanley Wealth Management, a fair amount of other folks I've spoken to, are really predicting a correction and more volatility to come back into the market. And that might be the catalyst that moves more money managers to do this sort of thing.